Good morning, and thank you for joining us in our webinar today. Today's topic is on fundraising essentials for startups in the MENA region. My name is Rayhan Aleem. I'm the managing partner and founder of Alpha Pro Partners. We are an accounting firm based in Dubai, and we're also Xero Platinum Partners. We're very pleased to be joined by Ahmed Arif, who is a co-founder of Clara. Ahmed, do you want to just give us a bit more of an introduction about yourself and what Clara does?
Yeah, sure. Thanks, Ryan. My name is Ahmed Arif. I'm a lawyer by background, before becoming an entrepreneur. I'm specializing in M&A, private equity, and venture capital. So Clara is a digital platform that helps founders form their holding companies in a number of jurisdictions and manage their equity, cap table. It's got a built-in data room as well and generates some key startup contracts like building an ESOP or issuing a convertible, which is one of the topics we'll be covering in our fundraising workshop today, sharing their profile with existing and potential investors. That's
Thank you very much for that introduction. So, just so everyone knows, we will be having Q&A at the end. So please add your questions in the comment section below. This session is recorded and it will be available on LinkedIn and we will be uploading it on to YouTube. So if you missed it and you registered, don't worry about that. We'll obviously send you a recording. Apart from that, Ahmed, over to you.
great. Thank you. So today we'll be covering some of the kind of what I call fundraising essentials, focused in the context of startups in the MENA region. And we will be covering the following topics. So we'll have a look at what the optimal investment structure looks like for your business. We'll quickly touch upon just what is due diligence, just to set the stage. Is it something that you'll come across for, of course, the very early stages of your fundraising journey? And then we'll compare kind of two of the main paths that are going to be open for you, convertibles or an equity funding process. And what are the differences between the two? And then we have a section on, what to expect documents wise for the equity funding round. And, depending on the time, you can go through a bit more of what a fundraising term sheet looks like, just to introduce some of the key concepts, some of the key terms that you see. Just before I dive in, a question to the audience. Maybe if you can use the chat to let me know if you have raised funds before or not, and if you've done that through convertibles or if you've done an equity round, just to get a feel for the experience of the audience. Um, so I'll just pause for a second, start talking about the optimal investment structure, but feel free to answer in the chat your situation, your experience. Okay. So here you see what I would call optimal investment structure, a pretty simple version of that. Down at the bottom is what we call an operating company. That's actually your business. So whatever you think of as your business, that's what the operating company is. That's the company that has the office space, that has the commercial license. It's the company that is hiring employees, entering into contracts, just doing the business, right? But if you're going to be fundraising, you're generally speaking, with very few exceptions, are not going to be doing it at the level of your operating company. What you'll be doing is you'll be setting up, if you don't already have one, what we call a holding company, which will own 100% of your operating company. Part of your fundraising journey, there will be a point where you and your fellow co-founders, fellow early shareholders will no longer be direct shareholders in the business. You'd all sit up top. You see founders, team members, early employees or shareholders, or if you have an ESOP, and then investors will come in at that level as well. Both convertibles and funding round, it would all go through the holding company, and that holding company is what's going to own the operating company. And there's a number of reasons for that. I think the first one is it's always good corporate hygiene to be one step away from the messy business of running a business, right? That's where liabilities happen. That's where you might annoy a customer or you might have an issue with a supplier, et cetera, et cetera. So, there's limited liability for the company. It's always nice if it's an extra layer and you keep your shareholding in an entity that's very clean, very passive, doesn't do anything really other than own another company and have obviously all the governance structures they have with your fellow shareholders. That's reason one. The more important reason is that any kind of professional investor, if you're talking about institutional funds, they have requirements as to where they're allowed to invest from a jurisdiction perspective. And it's quite narrow, right? So most professional investors, VCs, etc., they're not going to own shares directly in an onshore company or in a company that's in, you know, Dubai Media City or EMCC or anything like that. Then what they're going to be doing is they're going to be saying, here are the jurisdictions that I'm approved to invest in. It's things like Cayman, DI, Delaware, potentially. So in the region, it's ADGM, Abu Dhabi Global Market, and the IFs, right? And that's because these jurisdictions are ones that they're generally speaking common law based, and they've got a track record of enforcing investor rights, but also your rights as well as business owner. And they allow for a lot of the concepts that we're going to be discussing here in terms of enforcing a conversion, the different classes of shares, liquidation preference, governance issues, tag alongs, drag alongs, rights of first refusal, preemption right. Those concepts don't exist necessarily, or all of them don't exist necessarily in other jurisdictions. And there's that track record. Okay. There's this has been happening. We see disputes, we see court cases, we see enforcement, we're holding our rights in that. So that's the optimal investment structure. And as I said, it's even if you're just doing a day per convertible, this is something you probably will have to move to if you're raising from institution, professional capital. All right. So regardless of what fundraising you're doing, you probably come across this concept of due diligence. Again, particularly if you're talking about institutional capital, if you're raising from friends and family, if you're super early stage, there's probably not going to be a ton of due diligence, maybe some. But what is due diligence? Due diligence basically is a bit of a fancy term for an investor doing their homework. That's basically what it is. Most professional investors are not investing their own money, right? They have own investors. And so they've got obligation, right? So before they will give you that cash, they need to do their homework. They need to figure out, do you have this optimal investment structure? Do you have a holding company somewhere they can invest? Are all your licenses up to date? Do you have any issues with your contracts? Do you have any disputes? Do you have any IP issues? Because if you're a startup, IP is going to be a very big part of what you evaluate. And a number of other things. They want to maybe have a feel for your employees, your consultants, of course, do financial due diligence, which is have a look at your numbers. Even if you're at a stage, maybe it's a projection, you don't necessarily have a track record of numbers, but whatever numbers you have, they want to have a look at them. If you're a little bit later stage, it might be technical due diligence as well, where they might want to go have a look at tech stack, that kind of thing. That's due diligence. And again, even if it's early stage, you probably have a request for a data room and say, can you just give me this information, some documents? I want somebody to quickly look at it. So it's something it's good to be aware of. And it's good to be prepared with a data room where all your important documents are just there, even if you need to clean it up and reorder it before actually sharing it. And as I said, it really doesn't matter which fundraising path you go down. There's going to be a level of due diligence, even if you're not giving away shares, even if you're doing convertibles, there should be some level of due diligence as part of that. And I see from the answers on the stages that we've got people in the audience here who have experience with both convertibles and equity, and quite a few are done convertibles as well. Including one is using Flower. That was nice to see. Okay. So let's do a bit of a deeper dive into convertibles specifically. So what is a convertible? For those of you who haven't done them yet, it's basically, this is a gross generalization, but it's basically a type of contract where you go to the investor, you say, can I have some money, please? And at some point in the future, I'll give you some shares if I don't fail in the meantime, right? That's essentially what it is. And you say to the investor, it's too soon to talk about valuation. I'm quite early stage. I need a bit more traction. It's too soon to spend the months and months that it will take to do a full equity funding round. And we'll cover why that is. It's too soon to spend all that money as well on lawyers going through a full equity funding round. And it's too soon to distract me as a founding team with governance, full board, and all that stuff that comes with an funding round. Let's not waste time. And let's not waste money, and let's not then there's some mature track record to base evaluation on. Just give me the money and wait until I grow to the point where I pick up all of these things and go to the market and get a valuation for my equity. But obviously, I understand that's more risk for you as an investor. So in return, I will give you typically a couple of things. One is I'll give you a discount on that future round. So when I do go to the market, whatever my value is, you get a discount to that. Typically it's 20%, can vary. And then on top of the discount, I'll also give you what we call a valuation cap, which is to say, yes, it's 20% to whatever value I'm going to be when I do the round, but up to a maximum X dollars. And the reason you do that is things go gangbusters for you since you signed the convertible and the business skyrockets. The investor and their capital were a part of that, and you need to share the upside in that kind of high upside scenario beyond just the discount. So if you're hitting up against the valuation cap, effective discount, of course. So if you're raising at double the valuation cap, the investor's converting at an effective discount, 50%, not 20. So that's basically it in a nutshell. Give you some money, wait for the business to grow. Hopefully I'm successful. If I am, I'll give you some shares and I'll give you some economic compensation via the cap and the discount for the higher risk and going in early, time value of money, all of that. And then there's a couple of other things that go around that depending on how you structure the convertible. So you could have certain convertibles that say there's a time period and at the end of it, you have to repay me. That's terrible for startups because the money's of course gone, but a traditional convertible loan would technically work like that. It's very rare to see that. Or you could have a twist on that, which says there's a time limit of 2 years. If you don't do a round, maybe you will repay me, but maybe just, yeah, I can force you to give me shares. So that's what we call conversion rights. Okay. And a little more reasonable, but also quite problematic because the whole point about waiting to do a full equity funding round, you'll see what's involved in that is to flesh out not just the valuation, but to flesh out a whole bunch of governance terms and investor the deal terms. So to flesh that out with a lead who's typically a VC, who's typically hiring lawyers. It's a process at the end of which you have a set of documents with a certain governance framework that then all the convertible holders tag to essentially by saying, I'm going to just sign up for the same terms. So if you do a forced conversion, you haven't gone through that process. And so you have to sit down and figure out with your investor, your convertible investors who might be perhaps not financial investors, who may not have external lawyers, and they might do to try and go through like a mini equity process without actually any new cash coming through the door, just to come up with that governance framework, the basis on which you can issue shares in conversion. So it looks nice on paper, but it's quite problematic in practice. Yeah, those are, I would say, the key parameters of the convertible instruments universe. And in terms of the types of convertibles or the name that you might see out there, obviously there's the convertible loan, and then you'll hear the SAFE, which stands for Simple Agreement for Future Equity. And then you'll hear the term KISS sometimes. It's simple security. SAFE is something that was created by YC later, but is now probably the most popular form of convertible. KISS was originally created by 500, but again, a lot of other investors use it, or good old fashioned convertible note, convertible loan. Generally speaking, convertible loan is one that carries interest as well. Again, not usual that you repay it, but it just adds to the investment amount. So if the loan is outstanding for 2 years, there might be 2 years of interest, and so you're giving them shares with the investment amount plus 2 years. Whereas the SAFE doesn't. Generally, a convertible loan now has an expiry, maturity date. Again, hopefully not to repay, but to maybe perhaps force a conversion. Generally, a SAFE doesn't. So a SAFE has no interest and it's completely uncapped in kind. So it's a more startup friendly one, I would say. And then a KISS is a bit of a mix of the two. It's like a SAFE, but it's got a maturity. And again, the other thing to watch out for is no matter what they're called, people change these things in them. So you should actually leave them. Somebody could call it a SAFE and add interest, or somebody could call it a convertible loan, but actually it's a SAFE. So don't get too hung up on the name. Just make sure that you go through the actual terms, and if in doubt, maybe do consult something. And then we've covered this, but just to summarize why a convertible, it's significantly faster. So if you've got an investor who is coming in and telling you I want shares, which happens a lot in the region, maybe they haven't invested in startups before, they understand shares, that's what they've done, in SME context or in a large traditional business, and you're super early stage, then you have to, and you're also raising a small amount, you have to explain to them that an equity, if I give you shares, it's going to take anywhere from 3 to 6 months. It's going to cost tens of thousands of dollars in fees. And that's not very efficient use of that capital. kind of going to end up with a structure where I've got result matters and veto rights for investors and board meetings and all the rest of it, which is a bit of a distraction. It's actually in your benefit as an investor, and investors who are experienced in this space understand this, to not put me through that, because they're at a higher risk they're going to burn off the cash and take off my bandwidth, when you should be wanting me to invest every dollar that I can into the business and to focus just on getting it to the next stage. So speed, of course, no negotiations really. You're going to negotiate an valuation cap. Discount typically just lands around 20%. And then you should just use one of the standard forms that are out there. Don't waste time. If somebody's marking it up and adding, I want a board seat and this and that, and these the veto rights, and then they're not in the right headspace for a convertible. And also, you don't need to actually issue shares, which means you don't need to do KYC on them. You don't need to do filings, which costs money, et cetera, et cetera. So it's just generally a much, much simpler, cleaner way, and just recognizes the reality that at a particular stage of the business, there isn't really any advantage in all these pages and pages of rights, right? It's just about getting business to the next day. But obviously, on the other hand, this doesn't mean that investors have very limited rights. It's a much higher risk instrument for an investor, which means you're limited, generally speaking, by how much you can raise. You're not going to go out there and get $10 million. Your typical ticket sizes are going to be, can be 50 grand here, 100 grand there. You might raise $1 million, 2 million, 3 million. That's pretty much your general unofficial cap. If you're the type of business that needs a lot more capital than that, then you're mature enough to go through the equity round. There's also potential for material dilution, because you're not solidifying your dilution at the time you're issuing those convertibles. It all depends on the valuation you get in the next equity round, and you can't control that. So you can find yourself in a situation 2 years down the line when you go around, and all of a sudden you've given away 60% of your capital or something like that. To say that raising money on convertibles is like spending on a credit card. And if you don't keep an eye on it, you get a nasty bill at the end. So it's easy to find these things and see the money go in, but you have to keep an eye on, run a scenario, simple scenario modeling. If I do an equity round at this valuation, I'm raised this much, and this is the cap and this discount. What does that look like? What's my dilution as a founder? And make sure that you stay within a sensible range and don't overdo it convertibles. And remember, this is a valuation cap, but there's no valuation bar, right? But you raise that $1 million, they're still getting their shares at $800,000. They're 20% discount. So it really all depends on the valuation. Next one. And then there's the misunderstanding amongst the parties, because you're not going through that process of fleshing out those terms. Now you actually have to do that later. So you're kicking the can down the road on what the investment terms are. But over the whole, I would say there's really no reason not to raise funds by convertibles if you're an early stage business. I think it's a waste of time for all the reasons we mentioned to go through an equity funding round. All right. So we've gone through all these concepts. So that's convertibles. Now let's go through what an equity funding process would be. So that's when you actually have a fixed pre-money valuation, evaluating the business, and you're actually issuing shares immediately at that time to investors. Okay. That's what we call equity funding. You might hear equity financing. It's the same thing. Yeah, it's the round, right? So this is like your Series A, your Series B. And this is broadly what the process looks like. So at the very beginning, before anything starts, you need to figure out, as a founding team, as a business, what is it that you're asking for? Do you have an idea of what valuation? Do you know how much you want to raise? Do you know who you want to raise from? Because picking the right investor is probably the single most important decision, more important than your valuation, if it's your first round. So who, where, what's your investment thesis? There's actually a lot of work that goes into this. And those of you who've been through the process will know this before anything starts. And you're identifying your investor universe, you're doing those initial reach outs, et cetera. And then at the end of that process, when you get a few warm discussions, maybe some very light touch early due diligence, as you can see, typically proper due diligence happens later. And I'll explain why. Then you might get to the term. I got the term. But actually, while I go through the rest of the timeline, just another question for the audience. Feel free to type in the chat what your estimate would be for this entire timeline. I'll give you some examples of what it is. So you've gone through the ask, you've done your cold outreach, you get your term sheet, which is non-binding. Touch upon the term sheet in a little bit more detail next. Just a non-binding set of terms, usually very short, 3 pages, 4 pages, really shouldn't be more than that. Mostly to talk about valuation and some of the key investment terms. Then when you get the term sheet, you sign that. You typically sign it just with your lead investor. You need to pick somebody who drives the process. Could be that they're the biggest investor. It could be that they are just the most strategic or the most institutional, like the one that has the lawyers, basically, the one that has the experience. And you take those terms, and then a couple of things happen. So the first thing is due diligence starts in earnest. So we talked about that early on, what that means. The reason that it starts in earnest only at this stage is because due diligence costs money, right? And an investor doesn't want to spend that money unless they have a serious deal. Even though the term sheet is non-binding, it still shows seriousness and shows progress that he wants to spend the money. And it does have usually one binding term, which we'll go to in a second, around exclusivity. And the reason for it is because they're going to spend money on due diligence. This is when they hire the external lawyers. They're not doing it internally anymore. This is also when you're going to do documentation. So we're going to show you what the documents are in the next slide. That this is when the lawyers go off and then they do the full form documentation, which is dozens and dozens of pages, not 3 pages. Once you get your documentation done, there will be what we call pre-completion period or conditions precedent, which are essentially anything that's identified in due diligence that needs to happen after you sign the deal, after you sign the binding deal, but before you go to completion, where you get the money. So it could be that they've identified that you set up a holding company, but maybe that operating business isn't connected to them. You haven't transferred the shares. Or maybe there's an important license expired. Or maybe there's an important license that they think you should have and you don't. Stuff like that. That's important enough to stop the deal, but not important enough to stop you signing the deal. So you sign, and then we give you a period of time to just go off and do these things. Once these are all satisfied, then you move to completion. So that's cash in the bank, and you do the filing and give them the shares in return, ideally on the same day. And then after completion, you have a post-completion time period. Not always. So post-completion would be, again, things that are identified in due diligence, but they were not important enough to be conditions precedent. So it would be what we call conditions subsequent. So it could be that they say, okay, we'd like for you to apply for this, like take 6 months after closing, or we'd like you to do this transfer or this restructure or whatever it might be, re-sign this contract, whatever it is. It's important, but we'll fund you anyway, but please do it in the next 3 months. That's the post. There's also a period for warranties, which you can get to, but that's basically as part of the deal. You're going to be giving some statements around the business, and everything's fine. There's nothing they don't know about, or any skeletons in the closet, or any litigation they haven't told them about, or claims, et cetera, et cetera. Everything's okay. You get a chance to disclose against that as well to say, by the way, here are all the problems. Anything you didn't tell them, anything you didn't disclose against, that isn't the warranty, you're on the hook for that. And if they find out the next 2 years, sometimes, it depends, then they can bring a claim for kind of compensation for any damages as a result. So that's the post-completion. So the story doesn't quite end once you get funded. There are kind of tail ends of liabilities and undertakings and things that you have to keep an eye on. And that goes back to this whole thing of why you shouldn't do this too early, because this is serious stuff, right? So you're going to have a lot of management to manage this, not just the process, but the. So in terms of the documents that you see in the process, that's what that looks like. Quite a few, more than some people think. And so we talked about this term sheet. Do a quick snap of it next. There's the shareholders agreement, which is the governance document. That's the stuff that says who's on the board, who has the right to appoint people to the board, what are the share restrictions, lockups, vesting, preemption, rights of first refusal, tagging, loss, counter. So that's the living document that comes into effect on completion, not before. And that's what you live with, go back to what are the veto rights of the investors, which is very important, et cetera, et cetera. The subscription agreement, that's like the money document. So that just says, here's my valuation. I'm going to do X shares to this investor, Y shares to that investor. Here are the warranties on the business. Here are the condition precedent, closing mechanics, who's going to do what, when, here's closing, etc. Here are conditions subsequent. Sometimes these documents are combined and sometimes the names are different depending on jurisdiction. But generally speaking, if you're talking about a region, typically do English law governed deals with holding companies in those kind of jurisdictions I mentioned, except Delaware, they have their own thing as the Americans usually do. These are the terms that you see. There are also resolutions. Don't forget about those. Right. On the board resolution approving the entry into the document, authorizing the founder to sign the documents. But you probably should have one of those for converters too, by the way. People forget, but it's a good practice to have a resolution authorizing you to sign. Sophisticated investor will ask for one. And show on the resolution because you're amending your articles. Because we're going to put a lot of that governance stuff, not just in the shareholders agreement, but in your articles. You are creating a new class of shares, preferred shares for investors. Quickly look at that in the search. You are allotting those shares. You're changing your board, right? You're doing a whole bunch of stuff. Potentially requires shareholder resolution approvals. You might see share incentive plans, SIP or ESOP, as it's sometimes called, part of the speed. Investors in your kind of Series A in particular always want to see an ESOP. They don't already have one. And they always want to have an unallocated pool of ESOP as part of the deal because they want to limit their dilution after the investment so that they preload some dilution on you to say, I want 8% unallocated ESOP as part of this deal before I come in. And I want to see the ESOP documents and be comfortable with the ESOP terms. So part of the transaction. And then restricted covenant agreement, that's a fancy way of saying non-competes, non-solicits. So they expect to see that. Certainly on founders, might be in the SHA. Potentially, if you've got some really key non-founder going to see your team members, they might be asked as well to sign up for these. And then IP assignment agreements, which are essentially documents that say everything that I'm working on as part of the business, I confirm belongs to the business. Doesn't belong to me. So if I become a disgruntled ex-founder or ex-employee, I don't go off and say, oh, this was actually mine and try and stop you from using it as the startup or duplicate it. So that's the IP assignment. An IP assignment agreement out of all of these, that's the one document that has to be signed by absolutely everybody, not just the founders, every employee, every contractor. Either it's in their contract as a clause or set of clauses, or it's a separate agreement. Every single person, no matter how junior, no matter if they're part-time, should be signing one of these. And you should be doing this as you go along anyway. But if you don't, that's going to be a due diligence item. And it's probably going to be one of those conditions that the investor says, go off and sign these before I close. So broadly speaking, there might be other things, but those are the sort of documents you'll see as part of the wrap. Okay. Very quickly, just so we have some time for Q&A. What is this term sheet? What are some of the various? We don't have quite the time to do a deep dive in any of these terms, so just to give you a flavor, and then if you've got any specific question on any of these, will be raised in the Q&A. So obviously, the term sheet will say, what is the company? This will be the holding company talked about, issuing the shares. What type of shares are you issuing? They're going to be preferred shares, which means that you're giving some preferential rights to your investor in preference to everybody else, i.e. the founder. What the investment amount, what the valuation, right? And what are those preferential terms? The most important one is liquidation preference, which is basically, do a whole session just on that, but it's basically saying, I invest in X dollars, and if there is an exit or a dividend, but let's just focus on exit, I want to make sure that I get a particular multiple of my investment back before anybody else sees. Typically, it should just be 1x. It shouldn't be more. So if I invest $1 million, I get $1 million back. Guaranteed, the money's there before anybody else gets their one. And just watch out that you can do what we call participating and non-participating liquidation preference, double dipping. It shouldn't be, I get $1 million back. And then if I own 10% of the company, I get 10% of what's left. It should be the higher of my money back or 10%. Keep an eye on that. And that really won't matter unless you exit at a valuation that's lower than the valuation that the investor assuming it's a wise. If you're exiting at a higher valuation, then their prorata, the percentage is always going to be higher. So for $1 million and I got 10%, so that's a 10 million post money valuation. If you exit at 20 million, my 10% is 2 million, more than the million, so I don't need to worry. But if you exit at 5 million, my 10% is 500,000. That's too low. So I get $1 million, not 500. I've got 5 million. Actually, my effective economic percentage just went from 10% to 20%. So in a down round scenario, the liquidation preference can really eat up your capital. Be aware of that. They'll likely typically should just have rights to normal dividends. And then can skip over conversion rights, but anti-dilution is the other big one, which you do a down round, but we're not talking about an exit. We're talking about the next round, like a Series B. And again, that valuation is lower than my Series A valuation. I've now suffered additional dilution that I shouldn't have suffered had you raised a value that's the same or higher than my value. And so you need to compensate. And anti-dilute to put me in a position you would have been had you not done the down round. So again, that's something that could eat up the capital quite quickly if you're doing those down rounds. Control terms. So reserved rights, those are vetoes. So you should be in control of the business, right? It's still early days. You should control the board. You should be typically a majority of the capital of the equity of the shares. So as an investor, I'm a minority. So all I want is just some veto rights on keeping. So any decision you take it, I'm not in the majority, so you can force it on me even if I disagree, except for these 10 things that board level and these 5 things that shareholder level or whatever it might be. And really important things like, improving the accounts or CapEx beyond a very large amount, changing the founder's compensation. That kind. Shouldn't be day-to-day stuff. It should be like quarter-to-quarter or annual stuff that comes up. But you have to go back no matter what majority you own and also get the approval of the investor or the lead investor or a majority of the Series A. There's different ways to kind of. The board, of course, typically an investor would want a seat on the board, just trying to keep your board small. Particularly in the early days, everybody wants to seat, but it should be, and you need to keep a majority. So if you've got a 5-person board, you have to appoint 3 and you can give 2 to various investors, like maybe 1 representing your seat, or your convertibles, and 1 representing the Series A. If you do have a situation where everybody's asking for board seats, you can do board observers. So basically, they attend, they get exposure to what's going on, they can discuss, but they don't vote. And then you get tag along, which we all get into preemption rights. So if you're doing a round, you'll have to offer your existing shareholders participate first before you go out to third parties. The first refusal transferring, not issuing shares, you have to offer it to your investors first as well. The drag is basically, it's important for you as founders. It's important for the investors. It's a way to have a path to exit because your cap table is going to get fractured. It's going to get messy. You might have some small angels or friends of the family. People might disappear. You can't reach them. So the drag just said, if you get a certain threshold, typically a very high threshold, including the founders, including a majority of the investors, saying until 75% or 2/3, they we want to do this deal and sell the shares to so-and-so, then you don't have to get everybody to say yes. The minorities forced into it as long as they're treated equally with everybody else. So that's not the drag. And then finally, very quickly, even though the term sheet is generally speaking non-binding and for very good reason, it's very short form. There is a reason, annoying as it is, that lawyers do draft the full form documents with 40 or 50 or 60 pages. So 3-4 pages, that's very, very, very dangerous for it to be binding. And also you don't know what the specific terms are and shouldn't be locked into the deal until you see every detail of the terms. But there are a couple of things that you might see. Exclusivity is the main one. So that says, now I've signed the term sheet. Now I'm about to hire lawyers and do that whole due diligence thing we talked about. That's going to cost me money. So don't turn around the next day and say, I'm giving your investment, I'm taking investment somewhere else. You have to guarantee that as long as we agree, you're not forced to agree, that my portion of the term sheet, my million that I'm going to invest is open to me and you're not going to pull that away. So for 60 days, maybe 90 is a bit much, should be 90, could be 30. Just give me some comfort to want to spend that money and spend the time doing that due diligence and drafting the documents and negotiating. So that's typically the only binding term. We might have costs as well, but you really shouldn't have a cost cover. Okay. I think I'll stop there or pause there. A bit of a whirlwind tour. Probably could spend 2 hours doing this, but yeah, we want to make sure you get to some questions. Rehan, do you want to open it up?
Yeah, so no, I just want to say thank you very much for that presentation. I think you've covered a lot in 30 minutes and very informative. And I'm sure everyone got a lot of value out of it. So thank you very much. Yeah, so we will start Q&A now. We've got one question at the moment so far, but I think you've covered it. And this question is, can convertible loans be done without interest?
Yeah. Yeah. So yes, I think a classic convertible loan should have interest, but you can do whatever you want in these, and it's not uncommon to have no interest. Although I would query if that's starting to look a bit more like a safe thing. There are other things, maturity, conversion, other things we talked about, but generally speaking, convertible loans are convertible loans and not kisses and saves because of interest, but you absolutely can also just have them without it.
I've got a question from myself. I want to be a bit selfish now. We have a lot of clients who are startups as well, and we've noticed that a lot of the startups they set up in ADPM. Now, you mentioned that there is DIFC holding company. You can set up a holding company in DIFC as well. What would you recommend of the two, and what are the pros and cons of setting up a holding company in ADGM versus the DIFC?
That's a very big question. That should be our next webinar. But I think broad strokes, I would say ADGM volume wise is by far the market leader here, by far. The IFC didn't really have a holding company structure. They had one that was very specific, not really suitable for early stage startups until very recently. That has changed, but it's a bit of catch up on that. From an investor perspective, they would be comfortable, generally speaking, the IFC or ADGM in
Yeah.
terms of both investment jurisdictions. But so the DIFC is just a little behind. So the vast majority uh, of deals in the region, I would say, would be going to ADGM or something completely offshore like a K.
Well, no, thank you very much for that. I'm just going to fire a few questions that have come up. I'll try to make them a bit more. There's some specific questions and some generic. So I'll probably go more with the generic questions. There's one question from Richard. He's asked, if I have a safe, do they sit on my cap table before conversion?
Yeah, it's a good question, Richard. No. And that's no in the formal sense, but yes in the scenario modeling sense. I'll explain what that means. Your quote cap table includes things that exist, like shares that you issue, options that you granted, but also rights over shares, which is what convertibles are. The thing is, though, we don't know how many shares we're going to give under that convertible until we know your valuation of your equity on the ground, and also not just your valuation to be on the fact. But essentially, you need to know the pre-money valuation at your equity round before I can tell you this $1 million shares equals 50,000. So if I don't know the number of shares, there's nothing really to input into the cap table or to tell you what your dilution is going to be. All there is a notation that says there is a safe to someone. And the terms are of the safe is $1 million, 20% discount, $10 million valuation cap, potentially interest, convertible. And that kind of notation is all you can add in a different tab usually on your cap table. So that when you run a scenario to say, okay, fine, I've got all these saves, I know these data points. What if I do around at 15 million and I raise $5 million? Then I can do a simulation of what that safe would look like, how many shares I'm going to issue and and then put it on the cap table, at least in synthetic, right? But it doesn't go fully and officially and in a fixed sense in your cap table until you do the equity round and it becomes your Series A. Okay.
Thank you very much for that. We have a question, but this is from an investor's perspective. This is from Angel. To invest in a safe, do I need to be an accredited investor? Are there any limitations in the UAE? So this is from an investor's point of view.
Yeah. Sure. The short answer is no. You don't need to be an accredited investor. From the investor's point of view, it actually doesn't really matter. It's actually from the startup's point of view that they have to be a little bit careful in some scenarios. From the startup's perspective, you cannot be publicly soliciting investment, just public in general. That's where the accredited thing comes in, right? There are different rules if you're just speaking to your average Joe versus professional investor. And as you can imagine, protections for the average person are much, much higher. So you can't be, as a startup, going out there and soliciting and just advertising and putting up a billboard on Shigzide Road to invest in my startup. That's not allowed. But you as an investor, that's not on you. There are no limitations on you. You can invest. Protections are for you, right? As an investor. So you can invest whatever you want. That's not a problem. If you are raising funds, other people can invest in the state, then there's a whole bunch of other issues, which essentially in itself. But if it's just your money, go for your life.
Thank you very much for that. We'll just take one more, and then we'll wrap it up. There's a question from Ronan is asking, what are the consequences of having a Delaware holding company and switching it to AEGM even before raising?
That's a big question and involves potential tax consequences that are outside of my expertise. I just know enough be dangerous on that front. So I would just say, just generally with Delaware, yeah, you should be careful. People like it, but it's not really suitable, frankly, for non-US businesses and non-US person. And because there are a host of potential tax consequences, even though you can run it essentially tax-free early on when you're not making money, there are tax consequences. Sell, if you switch, you get capital gains. Is the switch seen as a sale, even if it's an internal reorg? There's a whole bunch of stuff that you might have to think about. If it's really early stage and you don't really have much money or much assets, you're probably okay. But there are potential tax consequences and the potential contractual admin, right? You've issued a bunch of safes out of your Delaware, and now you're going to have to cancel those, right? And reissue them. You have ESOP, you're given options, so you're going to have to redo those. If you sign any contract, you have to wind every one of those down and then redo them from ADGen. Not the end of the world. Wouldn't stress too much around it if it's early doors, but if it's a mature business, then the consequences can ramp up. You should definitely get some tax advice. It's probably the key one, the US Delaware tax advice.
Cool. No, thank you very much for your time and for your insights. I think it's been very well presented. It's been very useful as well, I'm sure. What's the best way for anyone to get in contact with yourself or someone in your team? You put your email on the last slide, but what's the best way for them to contact you?
Yeah, absolutely. Yeah, thanks for having me. And I hope people found it useful. I know there's a couple of questions we didn't get to. So yeah, please feel free to drop me an email. That is the best way. So it's just ahmed@clara.io. Just drop me a line. If you have any questions, thoughts, whatever, I'm available and happy to take some of those conversations offline.
Thank you very much for your time. We will be, like I said, we will be session is recorded. It will be available on LinkedIn, and we'll also share it with all of the everyone who's registered, and it will be available on YouTube as well. Thank you very much, everyone. Take care.
Thanks. Bye bye.